The gold price has just made a new record all-time high. Banks are now jumping on the bandwagon, with ING saying that the gold rally is just getting started. Bank of America also sees gold hitting $3,000 an ounce. If you haven't reached out to us at ITM Trading, I strongly urge you to book a strategy session where someone will reach out and connect with you and educate you about creating a wealth preservation strategy centered around owning physical gold and silver. You can easily book that in the Calendly link of the description of the video. Do it, you won't regret it. The gold price is within striking distance of $2,700. And my guest today says, well, the metal really has the Fed to thank. It's actually its most loyal friend. Joining me today, I'm so happy to have him back, Dr. Marc Faber, author of the Gloom Boom Doom Report. Dr. Faber, always good to be with you.
Well, thank you very much for having me on your show, and good day to all your viewers and listeners.
Yes, well, I was saying to you, I've been interviewing you for 20 years, Dr. Faber. And, 20 years ago, did we think gold would be at 2,700? Who knows? I don't remember what our forecast was back then. But let's talk about, your latest pennings here regarding the metal, because you say the rally that we're seeing is really thanks to the rate cuts we're seeing. And, we just saw the ECB announce its rate cut. Tell us your latest insights on gold here.
Well, it's very clear that the central banks around the world are again easing. In other words, they haven't tightened all that much, because had the money become very tight, we'd be in a recession, and we would have a very low inflation or negative rates of price increases. But this is not the case. Inflationary pressures are still there. And I think that investors are realizing there are huge problems in the sense that, say, we have in America two presidential candidates. One is plainly dumb, and the other one is also, like the first one, a big spender. They have no intention to cut the deficits at all, to cut the debt at all. They both will add, with different programs, to the credit growth of government in the United States. And the US is not alone. Other countries do the same. And so we will move one day into some sort of a financial crisis. Whether it happens tomorrow or in 3 years, who knows? Because you can postpone with printing money for a long time. But I think more and more, especially wealthy people, realize they want to have something of their assets in an asset that is relatively safe. I'm not saying it's 100% safe, because if governments could lock you in under the pretext of COVID, they can also take your assets away. And the first one to take away would be, say, real estate, because that's obvious to anyone. And it can be done in a very elegant way, in the sense that you just increase taxation on real estate until most people can't afford to live in their own homes anymore. So I think that gold is kind of a safe haven.
Because they can't seize that?
They can, but it's technically maybe more difficult. And as you know, different countries have different property rights. Say, in Switzerland and in Singapore, property rights are very strong. So to take it away from you in these countries would be quite something. Also in Thailand, I have to assume that, say, the king has some gold, so he's not very likely to want to take it from other people, because he would have to tender it himself. So all I'm saying is some countries are more likely to protect the ownership of assets of its individuals, and other countries are less likely to do it. And say in the United States, Mr. Trump is more likely to protect property rights than the communist that might be elected.
Well, I was going to say, where would you file the U.S. in that range of rights being, of things being seized? Where would they fall?
Well, they'd be high on the list because they did it already once in
Right.
1933. So they might move ahead. But I think it's today a little bit a different question because the ownership of gold is much more widespread. So politically, it becomes difficult to take it away from ordinary people. And what do you do with all the ETFs and the mining companies and so forth? So, but it's possible. It's possible.
I think I think that's a very terrifying point, that there's a risk that you could lose your house, Dr. Faber, that they could seize your home through taxation. Like that's a probability for you.
Well, they can increase taxation on homes. That they've done that in the 19th century in Britain. So a lot of wealthy people at the aristocracy had to leave their
Mm.
homes, their castles, because they couldn't afford it anymore.
I've spoken to economists advising both parties that you've mentioned, and you're correct. When I've had said conversations with economists advising both parties, they've been dismissive of the debt, of the US debt. And to your point, we've heard no talk of the US debt on the electoral stage. Can you lay out for us why we do need to pay attention to the US debt, and how close are we to the wheels coming off?
The wheels coming up. Maybe one of the wheels is already off. The economy is on three wheels. But I'd like to say this. I mean, the economists today, they are paid by Wall Street, and Wall Street is in essentially in alliance with the Federal Reserve and so forth. I don't think they want to present the truth. The fact is simply there's a point at which the government debt requires increasing interest payments. In that sense, one wheel has come off because over the last 18 months, the interest payments on the government debt have more than doubled. They're now at over $1 trillion a year. And it doesn't look as if interest rates will drop a lot unless we are in a recession. But at the present time, since the rate cuts occurred, the US Treasury market, long term bonds, have been actually selling off. They haven't been rallying. So the bond market doesn't like these rate cuts because the bond market knows that these rate cuts are inflationary. And the old economists, the classical economists, including, by the way, an American economist, Irving Fisher, he wrote about the debt deflation theory. The problem is, as government debts become bigger and bigger, an increasing portion of the tax revenues, in other words, you and I, we pay tax. The government gets these tax monies that we pay. These are the government's receipts, and they have to pay the interest on the debt first. So the interest payments on the debt actually retard other programs of the government that might be, say, more desirable, say, helping the poor in America,
Right.
or doing something about the infrastructure, which is not particularly good in the United States. So yeah, over time, the debt payments become burdensome and hinder or make economic growth totally impossible. So then there comes the day when the
Yeah.
government is actually forced to print money to pay the interest on the debt. And that is in the process of accelerating inflation a pillar that will make it clear and sure that the inflationary pressures actually accelerate. And when the inflationary pressures accelerate, the interest will go up and the debt payments will increase even more.
Dr. Faber, are you talking Ben Bernanke helicopter Ben Bernanke printing levels here?
Yes, I mean, my sense is if I look, actually, I'm just writing about this, about the 1970s and the 1982 crisis. And now I'm addressing the crisis of 1929. My sense is that the US is and other Western European countries, they are so far along in the process of fiscal deficits that there is no way out but to print money. There are ways out, but as a politician, if you go to your citizenship, then you tell them, look, we have to tighten our belts. What it means is you have to pay higher taxes, and you, the policeman and the fireman and everybody, you get lower pension receipts. we cut your nice pension by 30%. Do you think this politician will get elected? The politician will get elected who dismisses the whole debt problem and promises, oh, we'll cut tax here and we'll give you subsidies here and social benefits there and so forth and so on. All programs that lead automatically to higher inflation rates. In my view, the outlook is actually very negative, but it doesn't mean that because of that stocks go down. When you print money, stocks go up, like now. Stocks are among the highest valuation on record, and yet people rush in and buy at these record valuations.
You say you'd be avoiding it like the plague now.
No, because if you print money, in a marketplace, say you look at the US, and I think the US is expensive relative to emerging markets and relative to Europe. But say in America, talking about expensive are the FANG and the Magnificent Seven stocks, and maybe the semiconductors. But if you look at oil stocks, they are depressed. There are some real estate companies that are depressed. And say staple companies are have a relatively low valuation. But then there are stocks that have a very high valuation. So I'm not saying I would avoid stocks 100%, but what I'm suggesting is that we are more likely to be in the years between 1927, when Benjamin Strong, he was, I think he was the president or some leading employee at the Reserve Bank of New York. He wasn't Fed chairman, but he cut the discount rate at the time, and that then propelled stocks even higher. We are somewhere between 1927 and 1929. We're not like between 1982 and 84 at the beginning of a 40-year bull market. That I want to make very clear. The valuations are very high, and the economic circumstances, if you look around the world, the global economy is lower than at the peak in 2018, 2019. Yes, I can show you statistics that show the economic activity is basically lower at the peak than at the peak in 2018, 2019. There's been hardly any growth. Some sectors have been growing, but most sectors have been contracting. And in the meantime, stocks have gone to the roof.
To your point, because it really does feel like there's no way out. What are the chances that the U.S. would default on its debt?
It's extremely messy, but it's a possibility. The interventionists, they never really think through the consequences of their actions. They could say, we default on any debt that is owned by foreigners, but we honor the debt that is owned by local institutions and local Americans. They could do that. It would enhance the trust of the international community into the US dollar, and you could kiss goodbye to the US dollar being a reserve currency.
Yeah, I don't think they're going to willing to do that.
But they could do it. It's technically
Do
not
you
so
like
easy.
do you like the idea of a flat tax?
Well, as an economist, the only tax that is a fair tax is a flat tax. Flat. Anything else has a social agenda and is not an economic matter, but a social matter. Purely on economics, a flat tax, say, ideally 15%, and in the Constitution, it should be anchored that the government is not permitted to have a deficit, a fiscal deficit. So that would lead to essentially a sound household and to a small government. Small governments are good for economic growth. Big governments are a disaster, because you have all these employees in government. They never worked a day in their lives, but they go and tell the honest businessman and
Right.
small businessman how to run his business. These are the bureaucrats.
Exactly. Exactly. I want to also get your thoughts on the tariffs that Trump is proposing.
It's another.
You're getting me excited. I want to cover all this.
This is
You know,
another
look,
truly
it's a
disastrous
polarizing
idea,
topic. Why?
because the tariffs will increase the price of most goods for American consumers, and it will sort of anchor inflation in the United States and not lower inflation in the US. But and it will also make American industry even less competitive. You understand? The
Yeah.
tariffs protect, say, industries in a country, the industries that are not particularly competitive. And in economics, let's say, if I come to you and say, here are two apples, it's a locally manufactured apple, costs $10, and another apple costs $1, is from overseas and is of better quality. As a consumer, what apple do you prefer to buy?
Maybe it's as, I had Dr. Art Laffer on, and he said that he sees it as, he would agree with you about how tariffs are an awful idea, but he sees it as purely a threat, a negotiating tool, and not something that he would necessarily go through with.
Yes. The US is not in a particularly good situation to negotiate, say, with China, because A, Chinese exports to emerging economies are larger than to the developed countries of the Western world. In other words, Europe and the US and Australia, New Zealand and Japan. So the exports to emerging economies are larger. Number two, you have to see that a lot of exports of China to the US are actually not Chinese exports. They're exports by subsidiaries of, say, General Motors in China, or other US multinationals. They produce in China, say shoes, and then they export them to the US. So you're hurting actually your own industries as well. Number three, China has some products that actually the US needs. You know, it's not that China has no bargaining power in this matter. And
For
trade
example,
wars,
what are some products they have that we absolutely need from them?
rare earth materials,
Ah, okay.
and
Lithium.
many others. I mean, I'm not an expert on individual products, but many products the US wouldn't be able to do without China.
You bring up China, um, and you raise a very good point in your newsletter where you question to what extent could China export its deflation to the rest of the world, Dr. Faber. What's your take there?
Well, to some extent, they've done it already in the 1980s and 1990s. Without China, wouldn't have had this disinflationary trend. But now they are doing it again in the manufacturing goods industry. You know, there's no inflation in goods, but there's a lot of inflation in services. Like if I buy automobile parts in China, the price is maybe lower than a year ago or lower than 2 years ago, but the transportation cost to the US is up and the distribution cost in the US is up. So the overall cost is up, but the part itself has been deflating. Not all products, but a lot of products. But the
We
US has
start,
been inflating. I mean, look, I used to
yeah.
discuss this matter with uh, media people at TV station in New York, and I told them, look, do you really believe that your rate of inflation, in other words, the cost of living increases in New York, is 2% per annum? I looked at them, and all of them knew that their cost is going up like 7% per annum because rents went up, insurance premiums went up, but they denied it. They didn't want to tell the public.
Why? Why wouldn't they want to say it? I could
They
say
were
it.
told they were told by their bosses, don't provide bad news.
Oh, what a sad state of affairs. And
Yes,
unfortunately,
yes, you
the
said it.
media bias,
You
you know,
said
the
it.
media bias is even more pronounced today.
Yes,
Um,
I agree with you. I agree.
we started the show talking gold, so let's just go there a little bit further. Um, why have central banks been buying gold at a record pace? I mean, we've seen this little slowdown now, but what do they want to do with it?
They want to store. I mean, money has various functions. One is accounting unit. I don't think it's a very suitable accounting unit if you can print it. You understand? But say gold is a better accounting unit. Now they buy gold because they can have it delivered to their own country and put in a safe place in the central bank or in the treasury department or wherever they perceive it to be safe. We in Switzerland, we kept it in Bern. Then Napoleon conquered Switzerland. He took all the gold to France. So nothing is 100% safe. But uh, they the behavior of the US internationally and geopolitically has made many countries suspicious to hold all their foreign exchange reserves in the United States. You understand? If the US freezes the assets of even Afghanistan, what has Afghanistan done to the US? It's one of the poorest countries in the world, and the US freezes their assets. They freeze the assets of Russia. Then India and China and Indonesia and all these countries, they say to themselves, do we really want to hold all our assets in the United States? And they come to the conclusion, no, we want to have something safe. So they buy gold. And they can also see the money printing that is going on in the US. They can also see the debt grows, the government debt grows, and the interest payments grows of the US government. And so they don't trust the US dollar anymore. Now, the US
Well,
dollar has
that's,
up to
yeah,
now been relatively strong, and it may continue for a while. But I can tell you one thing, if the US dollar
yeah.
keeps on strengthening, what can be done is a bad intervention. Like every intervention is bad, but it can be done, and some countries have done it. They create a dual currency, one for financial transactions and one for trade transactions.
So they would use a separate currency for financial and keep using the US for trade, or vice
Then
versa?
you would have $2, one for trade and one for financial transactions. It's a very
Right. So
messy, it's a very messy
it
process,
is.
but many countries have done it in the past, and it's always led to a massive devaluation eventually.
Right. Well, I'm just saying this eventually will just chip away at the dollar if more and more
Yes,
countries jump on this
yes,
bandwagon.
yes. That's why
I'm just trying to see the end game here.
more and more people buy gold, silver, platinum.
Well, that's why I always say do as do what the central banks do. Don't listen to what they say.
Yes, correct. In my view,
Uh,
the central banks are a very evil group of people. They lie to the public about many things, including the true rate of cost of living increases, which is much higher than 2% or 3% per annum. Believe me, much higher, much higher.
you make me think, Dr. Faber, we haven't heard from Klaus Schwab in a while. Where has he been?
Well, he's been sidelined.
We'll see what brews there. Dr. Faber, it's always good catching up with you. I know it's so late over there. You're a night owl, but I still appreciate it. Come back soon, okay?
Yes, it's my pleasure to talk to you, to such a beautiful young lady. and
Even 20 years in, right?
yes, yes. Like good wine, it gets better and better over time.
Thank you, Dr. Faber.
Well,
I always
thank you
enjoy
very
speaking
much.
with you. I always learn something more, and I truly
Okay.
appreciate your
Thank
time.
you.
And thank you all for watching.
Thank you very much. Bye bye. Sawadee krap.
Thank you, Dr. Faber. Thank you, Dr. Faber. We'll see you soon.
Yes, thank you.